Yeah, so I am a NACFA certified valuation analyst. So we really take three different approaches to valuation. We look at it from an asset perspective, an income, and a market perspective. So we really try to provide a comprehensive valuation to our sellers and buyers looking to buy.
So you hear a lot about the asset approach to valuing businesses and also the income approach. And sometimes you will take a percentage of each to come up with a value, which would you consider that to be more of the market value that includes the intangibles and what's happening in the market at the time? Can you talk about that?
Yeah, so truthfully, I try to stay away from from the asset appraisals. At that point, I feel like it's more that they are just equipment heavy business, or they just don't have that cash flow that's there to value the business off of. I try to more focus on that income approach and market approach. Market's more based on everything that's happened in the market already. So things that have taken place, so we can see kind of on average what companies in your industry are trading at, and then also kind of assess what that high multiple is. Income is more determined by like your cash flow and taking that and comprising like a cap rate. And that goes through a variety of factors, your depth of your management, the size of your company, your local economy, your product differentiation. So we use all of that to apply to your cash flow and, complete a value based off that. Does that kind of answer the question?
Yeah, it does. Because, like at the IBBA, and because we're on the other side of it, Stephanie and I listing businesses for sale, they talk a lot about income and asset, and then we bring market factors into play. And so I get people that say to me, well, don't you just apply a multiplier to our business? So how do you, for the business brokers out there and people that are watching, interested in selling a business or learning more about the industry of being a business broker, do you hear that statement too? Like, what's the multiplier? How do we just figure this out? It's not a big deal.
Mm-hmm. I hear that all the time. I hear all different kinds of rules of thumb. I hear 2 times revenue, half of revenue. I hear all of it. And there are definitely rules of thumbs out there. There's like a business reference guide that I use just to kind of provide a sanity check at the end of my valuation. But it really depends on where the company is performing against the industry. And I think that's kind of where I spend a lot of my time researching what are the factors that make this company more valuable than the next company. Because I think the one thing with market approach where you can get in trouble is there are so many companies selling and trading in your industry, but most of the time, it's hard to say this, but most of the time, small businesses aren't making a lot of money. There's a very small percentage that actually have a lot of cash flow or making a good profit. So you really want to be mindful of that when you're going to value a company. Are they performing at industry? Do we want to take what the average is, or are they a little bit more valuable and we need to do a different approach at that point?
Well, and Brianna, we use you on probably a daily basis, I think, in our business. Brianna touches every single one of our come to market or decide whether if we're going to go to market more or less, because not every business is sellable. And we don't know that until you've done your entire report and analysis. But let's walk people through what all information, because it's not just the financials. You ask a ton of questions as you're trying to uncover what value is there. So Can you step us through that process?
Yeah. So when I first start working with a seller, I usually have a document request list. So we go through tax returns just to verify that the financials they're providing match. But I also want to see things like your organizational charts. I want to see the hierarchy there. That's what I was talking about, the depth of management. I want to see payroll summaries. Sometimes what an owner is paying themselves is below or over market value, and that really matters when it comes to valuation. And so just for example, if a owner is overpaying themselves, we can add back that money to the bottom line, and it actually looks then more like your company is more valuable. So what we're trying to do really is, we call it adjusting the income statement or the financials, is we're trying to find the true earnings power and how you present your income statements, maybe over or undervaluing what you're actually at.
I can tell you right now, Lisa Marie pays herself way too much.
That's because I'm worth it.
It's worth it.
I'm worth it, okay?
And I was just saying to these gals that I've been on the other side too, so I understand those things, right? We do tend to pay ourselves more than market value. I've met a lot of owners though that haven't been paying market value either, though, which is surprising to me. I'm like, why are you doing this? It's so much work if you're not,
right,
compensating yourself enough. So looking at those factors, and I think the one thing that's great about, being a CVA is they teach you where to find those things. You're kind of almost like an investigator at first, because when you look at that income statement and you ask a buyer or a seller, like what can we add back to this bottom line? Sometimes they're not even remembering the things that they've done that would be like a one-time expense, right? So we kind of do a trend analysis and we say, okay, your marketing across the board, it was higher in this year, or repairs or maintenance. What happened in this year? And they could say it was a one-time thing, a fluke, and it could be like a $20,000 add back to the bottom line, because that's not an expense that you're going to incur all the time.
That's right. And that's where this is where you become so much more valuable than just coming up with the valuation and what something is worth, because you're digging in like that investigator approach, to where we've had several businesses that, look, every single buyer is going to want to see the last 3 years of financials. Okay. And you might have a business that had to do a lot of remodeling to multiple different stores where the expenses were extreme, and that could scare a buyer off. But when they see that marketing offering memorandum along with the value and how you were able to add all that back in, it becomes extremely valuable, not only to that buyer to remain interested and possibly investing in the business, but the banks want to see that. The vendors, if they're going to finance, it's exactly that process that they need to see, that we've been able to utilize your services to not only come up with what we're going to price a business at, but to also get it underwritten properly at the lender level.
Mm-hmm. Yeah, and I think that's also what's great about evaluation, is it does provide justification for the value. So when we, write our reports, we're also saying this is what we noticed, and then this is why we did this, and this is why we didn't do anything with this. It's the same questions that a buyer is going to ask when they go through your financials. So you're kind of already doing the due diligence up front, which I think is great for a seller, because, you don't want to do that later when the deal's heavy and thick, and then they discover something and the deal falls through because of that.
That's right.